Okay, we're going to go through the Final Accounting Part 2 summary now. The summary is one of the first pages of the Final Accounting, but it's the last page you should fill out. It relies on, as you will see here in this slide, the materials you need include the inventory that you prepared in the previous lesson, and all these schedules that you've already prepared. The summary is used to combine all of these schedules into one mathematical illustration. It's used, and when you're finished with the summary, you'll have a total column that'll have all of the carrying value of all assets on hand at the close of the accounting period, which are also listed on Schedule E. So the balance of the summaries, all of the schedules, mesh together in a mathematical equation, which is nothing but pluses and minuses, and that algorithm leads us, it'll be the same as Schedule E. And this is where it is really the part where you just can't wait to see if it really worked. As you went through A, B, C, D, and E, you really hope that there will be a perfect balancing of the estate at this point. All right. Now I will tell you that when I first started doing when I did the very first final accounting, I was flabbergasted. I had no idea what I was doing, and I tried to figure it out all by myself, and it was just about impossible. It was impossible. But one of the reasons it seemed so difficult is I did the summary. I was trying to fill out the summary without filling out the schedules. I didn't know anything about them, so I didn't know what else to do. So that was a lesson learned. All right, so what does it include? Notice on the summary, this is a picture of the entire summary. I've just highlighted here the first row, part 1, which is the starting balance. The starting balance is the amount that's from the total in the inventory. So it's really important with your starting balance that you have a accurate inventory, because if you don't have an accurate inventory, you can really run into problems throughout the final accounting. This is also why I asked for a few people to change some things that they had illustrated or listed, entered, or whatever into their account or inventory, because it's really important that it all match up with what's going to happen in the long run, and that's the final accounting. So the starting balance, this first section, is taken straight from the inventory. It's just like a checking account. You put $1,000 in, you want to say that you started with $1,000 and then the following happened. For example, Schedule A. Schedule A shows receipts. Remember, we had the interest received, and if you go to your Schedule A, you will see that you have a total under the income column on Schedule A of $1,504. You'll also see that under the principal column of Schedule A, you have no dollars. If you add these two numbers together, you get the total. So right now, we're working across. This is from the Schedule A. You enter the amount under the income column, you enter the amount under the principal column of Schedule A, and then you total it, which is $1,504. Next, disbursements, excuse me. Got to be careful about that, don't I? Schedule B covers the disbursements. If you were to look at your Schedule B, and do that right now so you're following, you will see that under the income column of Schedule B, there is a zero figure under the total. Under the principal column, of the Schedule B, there's a total of $4,476.19. This amount plus the principal amount equals $4,476.19. So line 3 of disbursements from Schedule B is complete when you have these figures in there like this. Line 4 which covers distributions under Schedule C. 0 under income. If you look at Schedule C, you will see that under the income total there's 0, and under the principal total there's $216,212.00. 0 plus this amount equals this amount. Now, the second to the last schedule, remember we had to make up for that difference, that $9,000 that got lost and from the carrying value. So technically this carrying value should have been $237,763. But we can't change that. That inventory is our carrying balance. Down here in Schedule D, we explained the loss to the estate of $1,000, and it affects the principal only, and it goes right here. Lastly, this is Section 6. This is the section that must agree with Schedule E. The amount here, we're going to do all of this math in a second, but this, I just took this amount straight off of Schedule E. That's great. Schedule E, we did that math on Schedule E, and now we need to do the math to ensure that these numbers equal this amount. So we work with the totals. First, you take the starting balance, $238,763. You add receipts. That makes sense. You received money into the estate. That would be a new asset, and so we're adding the carrying balance, and we're adding to it the receipts that we've received. But look here, if money was paid out to creditors, for example, in Schedule B, those are listed, so we naturally would need to subtract this amount. So at this point, just to recap, we have the carrying balance of $238 some odd dollars. We add to that the $1,504 that was received, and we subtract now the disbursements of $4,476.19. And now we have distributions. This is the stuff that left the estate assets because it was transferred over to the beneficiary, Mr. Porter. All right? So now we started with this, we add this, we subtract this, and we subtract this. I think if you just think of the nature of these types of transactions, it'll make sense why you're adding this one and subtracting these. And then here we have another $1,000 we need to subtract from the carrying balance. And if you subtract that last number under Schedule D, that's the $1,000 we had to fix because of the $10,000 listed in the inventory was really $9,000. And here we have this total. It should equal, and I believe I've done it enough that it does, $18,578.81, which miraculously is exactly how much money is on our checkbook ledger, and it is miraculously exactly how much money is in our Schedule E. So there you have it. You have now prepared